G.R. Barton is with us, Principal, Woodshaw Financial Group. Glad you're here with us because I want to get your outlook a little bit for the near term and then a little farther out.
Yeah, well, I think one of the things that's been really interesting that we've seen, Nicole, and we saw it again this morning, is the true lockstep connection between bond prices and stock prices. So the bond price opposite of yields. Every time yields tick down a little bit, the prices pop, like happened this morning, and this moves the stock market up. The Nasdaq, in particular, the technical sections, technical index, popping with that. And I think that it's kind of unusual in this way. We had a few years back where we took the 10-year up above 2%, and it was like we had a big drop in the markets and all kinds of storm and dang about that. And what happened next was just another recovery. And I'm thinking that not in the near term, but in the next 6 months, we're going to see these two thoughts decouple from each other once again, and interest rates won't impact every tick the stock market like it's doing today.
Yeah, you know, it's interesting because we were talking about how fast they went up, right? As long as it doesn't happen as quickly. We watch the rates, yield, coupled with inflation, right? Those are the two things that we're keeping our eye on as a market overall. And especially when you see that on the rise, it really hurts those tech stocks. As you look at what's going on in the rotation to some of the cyclical stocks, people are looking at value stocks, but you say you're buying on the dips. What are you buying on the dips specifically?
Yeah, well, I think that there are two different dips to look at here, Nicole, because you just mentioned those cyclical stocks, the industrials, the material stocks, the financial stocks that are moving opposite of the tech stocks, the big, especially the mega tech stocks. When mega tech has a down day or a down week, those other cyclicals have a big, strong move. So I think as the cyclicals pull back, and we're having a little bit of a pullback day today, one of the stocks that I really like, Honeywell's off 1.5% or so. And I think when you get those pullbacks, it's down, Honeywell's down off 4 or 5% off of its recent highs. That's when you can add to those positions in those cyclical stocks. And you can do the same thing on the other side with the tech stocks during pullbacks. So one of the ones I like there is Taiwan Semi. Taiwan Semiconductor was up above 140. It got to 142. It's pulled back. It was as low as 113 last week. And I love it right here. It's strong today, up almost 4% with the interest rate machinations that we've been talking about. But Taiwan Semi cannot make any more semiconductors than they are right now. The world's biggest foundry. They are going 24/7, chock-a-block, and I think that's going to keep going for the rest of the year. I really like them.
Yeah, Taiwan Semi and Honeywell, as you talk about these names. The economy, is it all contingent upon, so overall you're feeling optimistic, right?
Oh, very much so, and for one big reason, and that is stimulus with a capital S, both monetary stimulus coming from the Fed and saying we're not acting, right. The dot plot showing we're not acting till 2023 or later, and then the fiscal stimulus, the money in people's pockets from Congress, all of that coming together to just put a great big old backstop under the market right now.
G.R. Barton, always great to have you on the show. Thank you for joining us on this Monday, kicking off a new week in style with some optimism. We appreciate it. G.R. Barton, Principal, Woodshaw Financial Group. Thank you.